Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden meanings behind company reports. This time we're diving into Greenwave Technology Solutions proxy statement. And boy, do we have some interesting things to discuss, including a proposal that could shrink your shares. So Greenwave Technology Solutions is getting ready for its annual meeting of stockholders, which is scheduled for August 13, 2025. This is basically the company's big yearly gathering where shareholders get to vote on important company decisions and hear about what's going on. Think of it as a yearly checkup for the company, but instead of a doctor looking at vital signs, we get to scrutinize their financial health and future plans. This particular document, a preliminary proxy statement, tells us what they plan to discuss and vote on. First off, the meeting will be online only, a virtual gathering. This means you don't need to travel anywhere, but you will need to log in using specific details. They're providing phone numbers if you prefer to listen in or need technical help. It's a way to make it easier for everyone to attend no matter where they are. One of the main items on the agenda is electing directors. These are the people who guide the company's strategy. They're proposing 3 directors to keep their positions. We'll get a look at their backgrounds to see what makes them qualified to lead. They also need to approve their accounting firm, RBSM LLP. This is the company that checks the company's financial statements to make sure everything is accurate. It's like getting a seal of approval from an independent auditor. Then there's the vote on executive pay, the say on pay vote. This is where shareholders get to give their opinion on how much the top bosses are paid. It's advisory, meaning the company doesn't have to follow it, but it's a strong signal of shareholder sentiment. Following that, they're asking if shareholders want to vote on executive pay every 1, 2, or 3 years. The board is recommending every 3 years, arguing it gives enough time to see the long-term effects of compensation decisions. Now things get a bit more technical and potentially impactful for shareholders. Proposal 5 and 6 deal with issuing warrants. Warrants are like options that give the holder the right to buy company stock at a certain price. They're talking about issuing a whole lot of them, up to over 28 million in one go and another 11 million in another. Nasdaq rules require shareholder approval for issuing a significant amount of stock, especially if it's sold at a price considered below market value. They need this approval to issue shares related to these warrants. Proposal 7 involves approving the issuance of some preferred stock. This is also a way the company raises capital and it can affect existing shareholders. They're issuing 450,000 shares of this preferred stock as a deal to buy property. This next one is a biggie. Proposal 8 is about a reverse stock split. This is where a company reduces the number of outstanding shares, which typically increases the price per share. They're asking for permission to do this at a ratio anywhere from 1:2 up to a staggering 1:150. Why do this? Well, Greenwave says it's to meet Nasdaq's minimum price requirements to stay listed, make the stock more appealing to investors, and reduce administrative cost. They believe a higher share price can attract more investors, especially institutional ones, and make trading smoother. But here's the catch. While a reverse split can boost the share price on paper, it doesn't magically make the company more valuable. The total value of the company stays the same initially, it's just spread across fewer shares. This can mean your existing shares become more valuable, but it can also lead to dilution and increased price volatility. Plus, some investors might see it as a sign the company is struggling to maintain its listing, which could hurt its image. Let's look at the numbers. Currently, they have 1.2 billion shares authorized. After a 1-for-2 reverse split, they'd still have 1.2 billion authorized, but only about 30 million shares outstanding. If they go for the big 1-for-150 split, they'd have just over 400,000 shares outstanding. This dramatically changes the share structure. Looking at their equity compensation plans as of late 2024, there are no outstanding options or warrants that are immediately available for exercise, and hence no securities waiting to be issued from these specific plans. This is an interesting point, especially since they are proposing to issue a large number of new warrants in proposals 5 and 6. It suggests a strategy to raise capital through new warrants while having very little legacy equity awards waiting to be exercised. What's left for future grants? As of December 31, 2024, they had about 803,000 shares available under their equity plans. This is a relatively small number, especially when you consider they proposed issuing over 28 million warrants. This means the proposed warrant issuances are much larger than their current stock option pool. Let's peek at the executive compensation. For 2024, Danny Meeks, the CEO, had a total compensation of $500,000. This breaks down to $28,864 in salary. And a significant 324 is much lower, and a significant 321,000 50,000 mostly from salary and bonus. Interestingly, the salary listed for him in 2023 with the difference showing up as deferred compensation, and 2023 with the difference showing up as deferred compensation, plus $15,021 interesting $450,000 in other compensation. In 2023 with the difference showing up as deferred compensation plus $150,000 in other compensation. In 2023, his total was higher at $750,000, mostly from salary and bonus. Interestingly, the salary listed for him in 2021 is much lower than in 2023, with the difference showing up as deferred compensation. For other executives like Isaac Dietrich, the former CFO, compensation in 2024 was around $300, including a base salary of $64,624, was around $344, hand of large bonus of $230,100 plus stock awards. This shows a significant reliance on bonuses and stock-related compensation for the CFO in 2024. Now for the critical financial picture. Greenwave reported a net loss for 2024 of over $100 million. This is a huge number and significantly worse than the around $63 million loss in 2022 and $33 million loss in 2023. The total shareholder return, a measure of how well the stock has performed, went from 6.25 in 2022 to just 0.03 in 25. That's a devastating drop, meaning a $10 investment in their stock in 2020 were $10 investment in their stock in 22 and $3 in the around $65 in 2024 to just $0.03 in 2022 to just $0.03 flag, and directly explains why they might be looking at a drastic reverse stock split to try and stay listed on NASDAQ. Light flag and directly explains why they might be looking at a drastic reverse stock split to try and stay listed on NASDAQ. Their auditor, RBSM LLE, was paid $350,000 in 2024 and $340,000 in 2023 for audit services. These fees seem standard for the size and complexity of the audits they perform, especially given the company's financial situation. As usual with these filings, we see a significant amount of related party transactions involving the CEO, Danny Meeks. They leased scrapyard facilities and equipment from an entity controlled by him, paying over $1.5 million in 2024. They also bought vehicles from him for nearly $3.6 million and purchased properties for $15 million, with part of that paid in preferred stock and a note to his company. These transactions are substantial and indicate a heavy reliance on the CEO's affiliated entities for operational assets and facilities. When it comes to the Series A1 preferred stock, 450,000 shares were issued as part of that property purchase deal with sellers affiliated with the CEO. This stock is convertible into common stock but has limitations, including a cap on how much common stock it can represent. Looking at who owns the company, Danny Meeks holds a significant portion, over 45% of the voting power, largely due to his stake in convertible preferred stock. Joseph Reeder and Anson Funds Management LP are also major shareholders, holding around 7.4% and 7.9% respectively. This concentration of ownership, especially with the CEO holding such a large voting stake, gives him considerable control over company decisions. The company is seeking shareholder approval for its executive compensation practices. Given the financial performance we just discussed, this vote will be closely watched. It's essentially a report card on how well the shareholders think the executive team's pay aligns with the company's results. They are asking shareholders to vote on how often approval of executive compensation should happen, with the board recommending every 3 years. This is to ensure that compensation is evaluated over a longer period, aligning with business results. Returning to the warrants, the company is very upfront about the consequences if shareholders don't approve this proposal. They say they might have to repay investors in cash or seek other financing that might not be as good. This highlights how crucial these warrants are for their current financial strategy, likely to raise needed capital. It will also have a dilutive effect, meaning existing shareholders will own a smaller piece of the company. Proposal 6 modifies existing warrants, reducing the exercise price and increasing the number of shares that can be bought. This is also subject to shareholder approval due to Nasdaq rules. Again, the company warns that not approving it could lead to repayment obligations or other financing challenges. Proposal 7 for the Series A1 preferred. Stock involves approving its terms and issuance, again due to Nasdaq listing rules. This preferred stock, convertible into common shares, has specific rights and preferences that shareholders need to be aware of. Now let's circle back to that reverse stock split proposal. The company needs shareholder approval to change its certificate of incorporation. The board will decide the exact ratio between 1:50 to consolidate shares. This is a move to boost the stock price per share, which is currently very low. They are really emphasizing that the board has the final say on the exact ratio and can even abandon the plan if they decide it's not in the company's best interest. This gives them a lot of flexibility. The board is strongly recommending shareholders vote yes to give them this authority. Finally, Proposal 9 is essentially a blank check for the board to adjourn the meeting if they don't get enough votes for the other proposals. This allows them more time to convince shareholders to vote their way. This appendix outlines the legal language for changing the company's charter to allow for the reverse stock split. It specifies how shares will be combined and how fractional shares will be handled, in this case, rounded up to the nearest whole share. Now let's talk about what this all means. Greenwave Technology Solutions is in a tough spot. Their financial performance, particularly the massive net loss and the near total collapse of their stock value, is the big story here. The proposed warrants and preferred stock issuances, along with the potential reverse stock split, are all desperate measures to stay afloat, meet Nasdaq listing requirements, and raise much needed capital. These actions, while potentially necessary for survival, will likely be very dilutive for existing shareholders. The company's reliance on related party transactions, especially with its CEO's affiliated entities, also raises some governance flags. In my opinion, Greenwave is fighting for survival. The reverse stock split, while a common tactic to boost share price, is often a symptom of deeper financial issues. They need to show a clear path to profitability and sustainable growth. And right now, those numbers aren't painting a pretty picture. The risks here are very high, and shareholders should be cautious. All right, that's our breakdown of Greenwave's latest proxy filing. What's your take on these numbers and what they signal for the company's future? Do you think the reverse stock split is a good idea or just a band-aid? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more conversations about these corporate filings. Thanks for watching. See you next time.